Okay, thank you very much for having me back again. Again, as David said, I'd like to share with you a kind of top-down, bird's eye view of what we see happening in the deep water. I know we discussed it here a couple of years ago, so it's interesting to step forward 3-4 years and see how things have changed, because there have been some interesting changes, certainly in the deep water. The four layers I want to go through today with you are deep water discoveries, trends, deep water production, deep water development, and deep water costs, and bring all those together and tell you what it actually means for this particular area of the industry. So, always a good place to start with deep water discoveries and show you the long-term trend, and very simply show you what's happening. The green is onshore shallow water and the blue is deep water. So we've shown you this before, and you see what's happening the last 15-20 years has heavily been dominated by the blue, the deep water discoveries, of which I'm really thinking about 250 meters in terms of water depth. So it's dominating the discovery set globally. The red line, by the way, is global oil and gas consumption. So today we consume 50 billion barrels of oil and gas every year, 30 in oil and 20 in gas equivalent. So already you're going to spot that the last couple of years are not lying above the line, which is already concerning, but also quite supportive for the kind of long-term oil price. Some of the big discoveries you will have heard about, obviously Norway, Johan Sverdrup, even Eastern Mediterranean's in here, and then continued discoveries in Brazil with Franco and Libra. Remember, the Brazilian discoveries first appeared back here in kind of 6, 7, 8, 9, but they're still coming through the discovery database. But in this 2014 is obviously a bit early yet, but there has been a noticeable downtick in the absolute numbers being discovered. In terms of number of discoveries, offshore discoveries, it's kind of segmenting it by water depth, just always good to kind of cut the data in many different ways, but roughly 175, 180 discoveries a year, kind of consistently, through this last 14, 15 years. But I guess the key point is, even the ultra deep water, 1,000 meters plus, are really starting to dominate the actual discoveries. So that extra water depth category is again dominating here, just in terms of numbers. Then in terms of here, the next chart, which is the volumes. So the volumes of discoveries also split by those various water depth categories, 500 meter buckets all the way up. And you can see, as I was saying before, not just in terms of number of discoveries are dominating, but if you take the dark blue and the light blue, also dominating in terms of average discovery size. So that's where the biggest discoveries are still being found today. And then maybe a little bit more simply than that prior chart, just to give you some actual numbers. Again, the average discovery size, back here, 140, 130, 1,000 to 1,500 meters water depth, 250 million barrels average, and even up to 500 million barrels oil and gas equivalent at this quite extreme water depth so far. Of course, Brazil is going to be a big part of that average number. And again, just showing the kind of same data, just to set the scene here in terms of the decades. Roughly shallow water, deep water back in the 80s was comparable, starting to diverge away in the 1990s, still diverging somewhat last decade, but certainly in the last couple of years, there has been another step up in the average discovery size in the deep water just in the last 3-4 years. So that's one of those new changes that we have seen just in the last couple of years. I always prefer to look at the whole data set in this fashion, which is just nice big simple bubbles and putting different colors on it. So I think it's easier to see here. And then of course, I think last time we spoke on deep water specifically, we would have been, back here, maybe pre or just as Brazil was kicking off. But the trends on this, by the way, you start with the big discovery, shallow water, you keep pushing deeper water. This is water depth, by the way, on the y-axis through time, and we saw the big push into the deep water. We saw all of West Africa, Gulf of Mexico here. And then, we had this middle of the last decade dry spell. Really very small average sizes coming through here across all water depths. And then suddenly, as I mentioned, 06, 07, Brazil started to reappear. So it was like all these new plays, subsalt, starting to really become noticeable. And Brazil in green has continued through this period. The rest of the area is not so much. But then suddenly, in this last 3-4 years, again, a very encouraging set of data, with the red being East African natural gas. There's still a layer of gray in here, which is Gulf of Mexico. So there still is Gulf of Mexico coming through, lower tertiary, new play ideas still appearing in the data set, not quite of the absolute magnitude as some of the other new plays. And the yellow, which has really appeared in the past 1 or 2 years. West Africa, again, new ideas, subsalt Gabon, shallow water Congo, down here in terms of the yellow, starting to potentially, they become some of these new trends for the next couple of years. So discovery data, it's always changing. It's never, we never look at this and say it's over because it has reappeared. Are these trends going to continue? Big question marks. That depends on the next layers that we'll talk about in terms of costs and development speed. And the final way I'm going to split the discovery section and the discovery data is just simply oil and gas, oil in black and gas in blue. And again, even though we talked about this upsurge in discovery success and volumes recently, there's still a very heavy mix of natural gas. Ultimately, 50% of the last 5 years has been natural gas. So offshore natural gas, clearly a different development time or a development solution requiring a different set of conditions. It needs the liquefaction technology. So that's a kind of big question mark today. So just, still within this section, what does it mean? Sorry, the next section, deep water production. So we have all these discoveries. Many of them are in development. What does it mean for deep water oil production? This chart is just telling you the red line is deep water oil production, so over 500 meters. I mean, in 2014, it's still very small. I mean, this is the thing. We find a lot, but there's very small percentage in production. Naturally, you might expect that. There's still a dominant amount of oil here in the onshore. Shallow water here in blue is kind of declining a little bit, but the red line is deep water, maybe kind of 6% today, but ultimately will reach 10% of global oil production by 2020. So it is a kind of growth theme. It is still kind of happening. The green here, by the way, is just the average water depth of the world's average barrel. So that's just a function of averaging these three lines that we are going incrementally more offshore to bring on that next barrel. So it is growing. Natural gas on this chart shows a similar trend. So deep water natural gas, we spoke about it being half of the discoveries over the past 5 years. It too is slowly being developed, maybe not as much. It's only like 3% today. Maybe it gets to 6% by 2020. So still, again, you can see the preference for bringing on those discoveries is potentially a step behind. And then the big question is, can these, if all these discoveries were made over 1,000 meters water depth, are they going to keep ramping up as quickly as they have, or as quickly as the first set of offshore countries and discoveries did come on? So this is just over 100 meters, the first period of offshore production, really ramping up in the 70s, 80s, from 0 to 4 million barrels a day. So far, it's happened quite quickly at this. I mean, this is quite impressive. If we think about over this water depth, we've gone from 0 to over 4 million barrels again. So it's matched in terms of that immediate ramp up. Many of the countries here you will recognize, the countries we spoke about, West Africa, Brazil, and also the US Gulf of Mexico. So it has started off okay. I guess the question is, does it become a big dominant section like the blue area, which is kind of shallow water? So this is onshore in green. This is shallow water in blue, which grew quickly and still is a very significant part of global production. The deep water and ultra deep water at the top, it's starting to layer in. It's up to 4 million barrels a day. And as we said, we do expect it to grow maybe to 10 million barrels a day by the end of the decade. But it's still going to be a long way to take the same share as the kind of shallow water resource area has become today. So it's already feels slightly slower. in terms of the companies, and this is always the kind of key point. I mean, it's like, it's like North America with the shale. I mean, we spoke about 4 million barrels a day. North America has added 3.5 million barrels of black oil in 5 years, but there are 20,000 companies out there operating every day onshore US. So when you have that number of companies, things happen very quickly. The deep water, as we're talking about today, is dominated by many of the larger participants in the industry, as you well know. This is just 500 to 1,000 meters water depth, and you're seeing some of those very familiar names, the integrated oil super majors, who are really dominating the deep water production that we just spoke about. And obviously, even if you go to the 1,000 meter water depth category, again, it's a smaller list, but it is the biggest companies in the industry who take on these types of developments. That's kind of logical. You can imagine that in terms of the risk reward and managing all the particular risks. It still remains the domain of the super majors. We aren't seeing any change in trends in terms of this category of companies focusing on this particular kind of discovery set. So just for the integrated oil companies, again, I said they continue to focus on it. And if you look at their portfolios, and they're a big part of the world market, then deep water in blue and ultra deep water in black today is probably about 12% of their production, just their production, not global production. And same with the global production trend, that will increase. And by 2020, these guys will have over 20%, a fifth of their volumes coming from this ultra deep water category. So for them, it's still kind of, all systems go, and it's still very much part of the strategy. And in terms of, does that continue from here? Will that momentum continue? Then you start to look at exploration acreage, and you say, okay, are we still adding this type of acreage? Does that mean more exploration, more potential developments? And the answer here is yes, because if you just look at acreage or net acreage added by each of the kind of integrated oils, and I'm just taking European companies here, then you can see the last 3 years, yes, there's been some sizable increases in exploration acreage, and a vast proportion of that is deep water, ultra deep water. So you can tell that you should expect, and we should expect to see that the deep water continue to be part of the strategy for these companies. Just a very quick glance at one of the most, from my side of the fence, everyone was very focused on Angola, subsalt Angola this year, this potential new play. Again, it's taking time. Investors get very excited very quickly, and then when results don't come through quickly, they move away very quickly and move on to the next thing. But a lot of the acreage was added here in the Kwanza Basin, various blocks, various companies, various joint ventures. I mean, there has been a few announced discoveries, certainly coming out of Maersk and Cobalt here in black. And we're getting some volumes from here, maybe potentially up to 2 billion barrels of oil and gas. We've got some development ideas coming through for next year from Cobalt. So, maybe this looks like they have started to unlock this. As we go deeper, then we're still waiting to see what happens out here. I think, this last month from Statoil and Total wasn't a success. So it's still question marks in terms of the deeper part of the basin. But, encouragingly, some interesting success here in terms of this new play. So, but I guess the big thing that always makes me nervous and cautious about the deep water is, and certainly when I invest or I'm spending time with investors and kind of educating them and giving them advice, then the one thing we must always take into consideration is the decline rates in the deep water are materially higher than the current assets of the companies that these investors may choose to invest in. So, last year we spent a lot of time analyzing 75,000 wells globally across many basins. And we come out with this conclusion that if you're in Brazil or the UK or Norway, there are 9 to 12% median decline rates every year on the kind of well performance. And that's green, that's kind of with activity levels being maintained. And then there's a lot of examples, a lot of parts of the basins where activity has slowed because of economic reasons or resources kind of starting to deplete. And then you really see physical evidence, real data of much more substantial decline rates. And this is a major impediment to an investor who's thinking about a company growing if they start to really think about these numbers filtering in. So Deepwater Gulf of Mexico, I mean, that scares me even more because these are the real data. I mean, Deepwater, 23% median decline rate across all the wells we've analyzed in that basin, and much faster if you're in like a Macondo type environment where you just can't drill as you plan to drill. So, I mean, this may be very high margin stuff initially, but also it falls very, very quickly. So this is one of the big impediments to the growth aspirations or growth expectations for deepwater supply. But there are some good areas, and the one area that I do sleep very well at night is Brazil, because it is a new play, it is subsalt, it was deemed high risk, but it's come on incredibly successfully. And when you start to just watch all of the wells, so this is, each of these buckets is a well performance in one FPSO in the first part of the Lula field, subsalt Brazil, Santos Basin, and it started back in 2010. And there's 4 or 5 wells producing into this, and they've been remarkably consistent. There is a blue line down here with water cut, and as you can tell, it's zero. Just seeing no, water breaking through in any of these FPSOs. This is another one, Sapanoa, here over 4.5 years. So some very strong performance from that resource basin, which I think is probably one of the best resources on the planet today. So Brazil is good. Clearly they have scale. Clearly, big fields get bigger, etc. So I think this is, from my perspective, one of the most exciting deepwater opportunities. And I look forward to kind of sharing more of this data as more of these FPSOs. There will be 20 of these FPSOs coming on over the next couple of years. And here again, I'm just harking on about how good Brazil is. But no matter which well you take, whether you take Brazil or the US Gulf of Mexico, subsalt. So only the kind of subsalt wells, and you really average them over here, then the average is 24,000 barrels a day. If you see the median horizontal part of this kind of whiskers chart, and the US Gulf of Mexico 14,000 barrels a day. But ultimately, these Brazil wells give you a lot more oil. Potentially 2 million barrels a year of extra oil. And in Brazil, you make 25% margin. So, that's an extra $50 million of net profit to these companies who have wells producing in the Santos Basin versus, the US Gulf of Mexico subsalt play. So again, it's not just scale, it's not just productivity, it's ultimately bottom line effect is superior to many resources we've seen in the past couple of years. So those kind of, talked a little bit more positively about discoveries, continuing about deepwater oil, continuing about some of the good areas, some of the hindrances. The other big problem is complexity, and that's driving the cost debate and whether we should really be sanctioning and developing all of those projects that we're discovering. So there's many ways to look at this, but, ultimately people say everything's just more complex offshore. I think one way we tried to do this is, and I'll show you the next slide, is break out the complexity of each development. I guess at first glance, we haven't seen, or we don't tend to agree, that there has been a marked or a stepped increase in the kind of offshore complexity, certainly through the last kind of 13, 14 years. So I get, you're seeing that from here. There's actually a potentially downward trend with the complexity. Here it's another way to look at this, but what we're doing here is some developed fields on the left and some fields currently under development, and it's just one way to tackle this problem. Are offshore fields more complex? And we look at the reservoir, how difficult that reservoir is, the kind of lift mechanism, the hydrocarbons and type, the facility size and weight and everything about it, and its location, and give each of these components a score and derive a complexity score for a whole bunch of fields that were developed over the past 10, 15 years. And you can see, we're ranging from this kind of, 15 up to 30. The red triangles are development cost per barrel. So you can see that too has ranged from $5 up to the kind of $35 level as well. And then we go forward and say, well, what are we bringing on today out of the next 5, 6, 7 years? Same types of developments, give them the same score. And, and you can just look at the absolute complexity score, maybe slightly higher. Development costs, again, we're up at the $25 to $30 level. Still some pretty low cost developments in deep water out here. But, I look at this and say, there isn't some material change in project complexity. So I think that's good, because that means we can tackle these offshore developments. Maybe if you split this data in another way and just pull out some particular geographies, North Sea, West Africa, pre-salt, Brazil, then certainly, as you might imagine, the UK has kind of been bucking that trend. It clearly does show an increase in project complexity. So it's more of an average conclusion before. Geography specifically, you do see examples where it is becoming more complex. UK, North Sea is definitely one of those areas. West Africa, I'm not seeing anything noticeable in the kind of analysis that we do, and we're just pulling out examples of our West African database here. And pre-salt Brazil, this is where you're getting the low red triangles, the low development cost per barrel, and the ultimate complexity score being a little bit less, despite this being 2,500 meters water depth, despite it being 6-7 kilometers deep and through salt. So I think I don't quite agree that everything is just markedly more complex, maybe with the exception of the North Sea. One of the problems, though, which really impacts the economics, is just the time, though, to go from that decision to develop these fields and to getting that first barrel out of the ground. And many of these offshore developments are using FPSOs, kind of floating production storage offloading vessels, whether they're built from brand new or they're cut out of old tankers. That is the preferred development technique. And here I'm just showing you that over time, over the same kind of period, there has been a general increase in that time. This is months, by the way, on the y-axis, to go from that decision point to first oil. So clearly, companies are taking longer and longer and longer to bring the oil out, even though it is just the same FPSO type technology. But there's no reason for that. That shouldn't have occurred. If you take these three examples, which I've pulled out separately, Kizomba ABC in Angola, developed by ExxonMobil, and they are clearly bucking that trend. So, why can they, as they always say, design one, build many, show that trend, and the rest of the industry shows that trend. So I think that's a big debate that's happening today. You may have heard about more replicant designs and standardization starting to appear as themes within the industry. So I think this is something I hope to show you again where we might see this decrease. So deepwater costs, again, always the bottleneck in terms of getting these discoveries through the system. I want to start with the exploration side of it and then into the development side. So this is one way to look at this, the exploration capex, so the exploration budget divided by the reserves added organically through the drill bit each year. And ultimately, as many of you remember, it used to cost $1 or $2 to find those barrels. Then it started to inflate, and we're getting up to the 3, 4 level, 2006, 7, 8. Ultimately, exploration budgets went up, but we're not seeing the commensurate increase in reserve bookings so far from these companies. So we're still hovering even up at this $5 to $8 per barrel level. So already you start with today's oil price of 97, and you have to use $5 or $10 of that just to go off and find the first barrel. But I think another way to just show you all the different ways to think about that exploration number is just here, because the first one I was showing you was exploration budgets divided by the organic barrels produced, that kind of $5 number. But you can also look at it as exploration budgets or exploration capex divided by the barrels produced every year. Because you can be booking, the first category, you can be booking IOR, EOR barrels. You can be booking, discoveries that just became economic because of an oil price change. So this number is potentially a bit more valid, the $6.9 per barrel, because it's saying, as I'm producing, how much of that cash flow do I need to keep using to kind of reinvest to find the next barrel? So that's a higher number. That's $7 a barrel. Or if you go off and just look at 2P reserves found in the year and divide it by the exploration budget, then it turns out to be $7. So, these numbers are more like a $7 per barrel level. So that's what's costing today to find that next barrel. And that's significantly different from the $1 to $2 levels that we used to speak about. And it's across all the companies here in this next exhibit. This is just exploration cost per barrel, just stacked up. Mathematically, they shouldn't be added up like this, but it just gives you a sense of, the same increases through many of these kind of companies over time. So they're all, kind of spending this $5, $6 per barrel level to go off and explore. There is, Shell might look a large number here, but this is actually a lot of unconventional exploration in terms of North America. So that number should actually decrease a little bit this year. But I think the fundamental problem, so hopefully we laid out a case where there are discoveries, there are new plays clearly coming through the kind of success part of the equation. The complexity is not markedly different. There's no reason not to pursue them. But then when you go back up to the group corporate level of the industry and you say, okay, exploration costs are still a small part of the overall oil price. So, the kind of $5 level we were talking about. But don't forget then the development cost is the black area, and that's up at $25 per barrel, so another $25 to develop it. And remember, we're at 97 Brent before all the cost lines, before all the tax lines, before all the realization differentials you might get versus Brent prices. And you can see that what's happened is the blue area is the cash left over. After spending all of those lines I just mentioned, in 2013, we hit a new bottom. We're like, I think this is 77 cents a barrel in surplus cash flows, which is pretty incredible when Brent was $110 last year. We just haven't been that low since the 1990s. So, clearly companies are having big decisions to make. Can we pursue this deep water growth opportunity? And it's causing serious debate at the moment. And that's why one of the most interesting trends that I've noticed in the past year and 9 months is this data, which is simply projects which are being deferred and cancelled. And I've never seen this before, certainly over the last 10, 12 years. So this is number of projects, and you can see 2008 to 2012, there was a couple. 2013, 2014, we're up to 35 or so. By the way, prior to 2008, there are no examples, which is why it only starts here. In terms of production deferred, it's over nearly 2.5 million barrels oil equivalent of oil and gas, which was expected to come on stream in 5 years from here, but it's not going to. It's just further pushed out to the right. And then if you look at the actual capex, the dollars deferred or cancelled, it's over $200 billion just in the last year and 9 months, where managements have decided we can't allocate capital to this. This is staggering. If in the investment community, they love the words capital discipline. That's one of the holy grail for investors. They've never seen it in this industry for a long time, and they don't believe it, but I can show them this evidence and say, actually, it is real. They are doing it. But the point of me showing you this today is, in the pie chart of the various project types where I'm seeing these decisions being made for the first time, there's oil sands, there's LNG in green, there's refineries, there's some gas to liquids, there's some onshore plants, but 55% of all of these bar charts are offshore deep water projects. So clearly you could say that is the marginal barrel for the industry, for these companies' portfolios, and that's where the tough decisions are being made today. So that begs a question, therefore, should you be spending all this money on exploration, or should you be starting to look at existing barrels, which in terms of the equity markets are very, very deflated or very cheap versus history. And just here I'm taking a whole lot of pure play exploration companies, which are various valuations in the equity market, but they have barrels. And if you think about the average integrated oil's exploration budget of $3.3 billion already, that's higher than kind of the average value of these companies who have barrels there found already without taking on that exploration risk. So this will be the next big decision that will have to be made, and that has to be weighed up against this theme of capital discipline and kind of doing what shareholders want some of these listed companies to actually do. So I think decisions definitely in the boardrooms today are probably tougher than they have been at any point over the past, apart from 2008, 2009 when the oil price collapsed, but tougher than we've seen in certainly over the last 10 years. So if I could conclude then just on my 4 layers, the discoveries, budgets have picked up, discoveries are coming through, more modest in size, certainly across a wider range of water depths, which is interesting. A lot of shallow water discoveries coming up West Africa. Production is already going to grow from the existing development set that we have, should reach 10%. Don't think it's going to match the kind of shallow water ramp up that we've seen before, and could even be less if we see more of this decision making happening. Deep water projects are complex, but they're still favored by the majors and dominated by this group. And their production will still show a high weighting to this over the next couple of years. But if there's one area that bucks all the trends with replicants, repeatability, with the top quartile economics, it is Brazil. But the cost side is the single largest impediment to us really believing a material deep water growth story. The costs are rising, eating into the surplus cash flows. So we're seeing these cancellations for the first time. So what we really need to see is the costs to drop. We're seeing that already. Deep water drilling rates are starting to fall. We're seeing some of the companies be very successful in taking cost out of these developments. If we see more of that, we see the returns go up. And ultimately, this deep water project queue will come back. It's just very difficult to say when, but at the moment, it's kind of drying up. So at that point, I'll finish and happily take your questions.
Thank you, Ross. Okay, any questions, please? Yeah, at the back. And it would be good if you wait for the microphone and say who you are. Thanks. Where am I going?
Up here, please. Thank you.
I think so.
Hello? Does this work?
Well, just
Testing?
okay,
I'll project. So Peter Jackson, excuse me, Bain & Company. One question and one point. The first question, sorry, it's very transactional. The data from individual wells, where do you get that? Is that regulatory filings generally?
Yes, the ANP in Brazil, the DEC here, the BOEM in the U.S. Gulf of Mexico. It's all.
Yeah, apologies. I'm standing behind that kills all the sources. The second is a point. I think a really interesting point on complexity and somewhat intuitively different to I guess what I see working inside the ISCs. And I suggest that actually the underlying complexity of deep water prospects and developments is actually increasing, but what you're seeing is actually the sanctioned projects that you're seeing are the lower complexity ones, and the higher ones are actually the ones that are getting deferred. So on that point, I think the complexity is actually coming, although the underlying complexity in terms of location, reservoir, etc., may be static, the kind of non-technical complexity, so having to have relief wells or relief rigs, some of the environmental regulatory pieces, moving more to Angola, more to Brazil, actually that complexity is more and more. And so I think whilst you're saying underlying complexity looks about level, actually I'd say there's a lot of complexity coming through, and that's really killing the cost picture of non-sanctioned projects.
Yeah. You need to have a very broad database in order to do that. I think some of Total's projects in Angola. They're already saying these are the most complex that they've done. You know, Girasol and Dahlia multi-phase flow and stuff they've never done before, and they're receiving awards, obviously, in the industry for completing them on time, on budget. So, yeah, maybe. So I think there are some complex fields that they're still been able to pursue and get good returns on. But yeah, I take your point.
Let me ask you, it's an interesting way of looking at it, but there's one analyst who regularly looks at market cap of companies divided by reserves. And when you do that, you finish up with typically a number that's about $8 a barrel, something like that. So if you're entertaining $7 a barrel numbers to find and praise, never mind develop, you're actually doing no good for the shareholder whatsoever at all, because you're not getting any sort of decent return.
Yeah.
And therefore investors should be going, hang on, just, open the supermarket or something, but don't do this.
Yeah.
Is that right? I mean, do you think that? And the question is more, are investors beginning to think like that?
You're right. You can plot those windows over time. The market cap per barrel, the market cap per barrel, and the discovery per barrel, and the M&A or transaction cost per barrel. And there's certain windows where they open where it says this must be the right window to purchase barrels, rather than doing it. But at this point in time, we're not seeing a lot of that happening, because it's also married up with that low point in 2013 where the cash flow is as stretched as it's ever been, and returns are at the lowest point we've ever seen. I mean, it's really terrible, the kind of returns coming out of these companies. So they can't, and obviously, there is risk with these acquisitions. They're still in some tough countries where investors are saying OECD is preferred versus non-OECD. So there's many decisions, not just the mathematics of that equation.
Okay. Anybody else? Okay, very good. Thanks, Oz. Great as always. Okay.